The Trump administration has actually notified that tariffs do kick in from 9:30 a.m. on the 27th of August, which is tomorrow. But let's get in Manishi Raychaudhuri, CEO of Emmer Capital Partners. Manishi, good morning and welcome to the show. Always a pleasure to speak to you. Hiral on this side. We have now received the notification that it is happening. 9:30 a.m. is the time on the 27th. Not too much of a change that does come in because all of us know what the impact is going to be. The only thing was there was anticipation that the Indian government had a window of 20 to 21 days with regards to negotiations. Nothing has worked so far. How do you expect the markets to react on the basis of this now?
Well, the markets have already had, a flavor of, the kind of, sentiment depression, if I may use that word, could occur. So this has been well telegraphed. So I wouldn't think that the market would react immediately. But what may happen is that, gradually with diminution of India's geopolitical clout, which is quite obvious from what has happened over the past few weeks, there can be second and third order impact on capex, on investments, on several other products that India is exporting. And those things may actually impact corporate revenues and earnings going forward over the next few quarters, maybe not immediately. And the market may actually be quite, sort of adept, or, the market may actually anticipate that going forward. So, the long-winded response but in a nutshell, I wowould say that one would have to brace for, further underperformance on the part of India. India has already underperformed quite a bit compared to the global emerging markets. And I would think that, at least in the near term, that might continue. The only saving grace might be the large, domestic stimuli that's coming through. We have already seen that in both monetary and fiscal measures. We could see more of that from what we are hearing.
Got it. Manishi, one thing is the economic impact on specific sectors. The other is how much would it impact the markets as well? And my question to you is this underperformance of India relative to the EMs baking some of this in? Because I would guess the problem was twofold. Growth was suffering and the tariff piece didn't work out as we thought. Now, growth is being tackled. Is this discounted enough, or do you reckon it can have a further impact on markets?
When you say growth is being tackled, yes. I mean, there has been monetary and fiscal stimuli being pumped in. We have seen a jumbo rate cut from RBI. RBI has a lot of avenue to cut rates further. The real policy rate of India is about 4%. It's almost never been this high, except for one or two occasions in the past decade. So RBI has a lot of room to cut rates going forward. The government has, in the budget, given an income tax stimulus, a direct tax stimulus over there, and now they're coming up with indirect tax stimuli as well. But what the investors would look forward to before committing more capital is the impact of these on Indian consumption, and that has not come through yet. If you look at urban consumption, if you look at auto sales, for example, they're still heading down. If you look at the commentaries that are coming in from both consumer staples and consumer discretionary markets, they are sounding increasingly cautious. So I think investors would want to have a flavor of the earnings estimates bottoming out and beginning to move up before committing more capital.
That's an important point that you raised. Manishi, the point is, however, and a counter argument to that, and hi, good morning, Alex here, is that if you wait too long, you might just have the horse bolt and then you'll be left with a loss of opportunity. In the context that you have major global markets that are running significantly hotter than India, and so there is a valuation gap to that extent, is there a case to say purely on the back of that foreign institutions must look at India with more attention than they have in the recent past?
The simple answer to that, Alex, would be not yet.
Okay.
Yes, the other markets, other Asian markets have been hotter than India. We have seen Hong Kong move up 25%. We have seen Korea move up 30%. These markets, despite this huge outperformance, are way cheaper than India. I mean, today, Hong Kong trades at about 11 times price earnings multiples, Korea at about 10 to 10.5 times. Korea's valuation discount to Asia ex Japan is about 28%. And the long-term average valuation discount, Korea has always traded at a discount, but the long-term average is about 20 to 22%. So it's still below the long-term average. So despite the fact that these North Asian markets have outperformed India massively, investors can still find much cheaper pockets in these markets than they can find in India. And more importantly, many of these markets and many of the sectors within these markets are actually having earnings estimate revision upwards. Just yesterday I published a report on this where I could identify about 11 country sector combinations which are having a consistent earnings estimate upward revision. None of those sectors are from India. Many are from Hong Kong, Korea, China, even a few from the Southeast Asian pockets.